The Australian Financial Review.
I'm James Thomson, Senior Chanticleer columnist at the AFR. Welcome to our weekly news breakdown of all things business, finance and markets. With me today, as always, is my Chanticleer colleague. Hopefully he's having a better week than the ASX. It's Anthony Macdonald. How are you, Anthony?
Long energy, short financials, James, as usual.
Fantastic. This week we jump aboard the AI train rolling through markets. We take a look at what's wrong with the poor old ASX, and we preview RBA Governor Michele Bullock's big interest rate call. But first, Anthony, let's start with the big corporate news of the day. ANZ's maiden half-year profit under the new CEO, Nuno Matos. Anthony, Nuno came in with a storm in the middle of last year. He tore through the joint, set some ambitious goals last October, and he really wooed and we should say won over investors. Are we seeing signs of the big turnaround in this first set of numbers from Nuno?
Yeah, we are, James. I thought it was a credibility-enhancing result. You know, Nuno came in last year, released his strategy in October, like you said. This result, for me, it's bang on it, right? The strategy has two legs. Get the business match fit, then try to grow. He's done the heavy lifting on the first part, big cost out. He's 3/4 of the way through his 3,500 job cuts, focused on margins, costs, capital, and he's got those numbers going in the right direction.
Yep.
That's good. I mean, he even upgraded the cost out target, $875 million now, up from $800 million. Also good. But there's bugger all top line growth, isn't there, James? And you went straight to that point when we spoke to him this morning. Credit growth, it's very strong across the market. This bank's pretty much standing still. Yeah. I mean, that's his next challenge. Having rebased it, having thought about where ANZ can compete and how, he's got to look outwards, and he needs his troop looking outwards and get out there and win some battles, you know, get some more business. And he says he's starting to see that. He says, just look at mortgages numbers that just came out this week, and ANZ is finally sort of keeping pace with the big four.
It is.
But it's still below system growth. You know, keeping pace with the big four, it's just not the game. So his challenge now is just get to the second leg of that strategy to grow, not at the expense of the first, which is resetting costs. That's a tricky balance. But James, I thought credibility enhancing. What did you think?
Oh, I almost think it's too much of a good thing too soon. If you look at some of the big targets he said, I think the return on tangible equity target, which is sort of the yardstick for how banks are travelling, he wanted to get that to 12% by 2028.
Yep.
It's already at 11.6%. I mean, I'd give him the benefit of the doubt and round up. Tick, he's done. He wanted to get cost to income ratio in the mid-40s. It's already at 49%. You know, I'm feeling generous, round down, tick, done. But I think the problem is that once you hit these targets early, everyone goes, okay, that's great, well done. We've banked that into the share price. ANZ shares are up 30% in your first year, Nuno. Time for the second phase, please. Can you bring that forward a bit? We'd like to see some growth. And I think what we've forgotten, and I don't think ANZ or Nuno Matos has forgotten this, but with great cost cutting comes great disruption. You know, they've taken 3,500 jobs out of the place, or they're well on the way to doing that. Of course the business is going to struggle a bit. Imagine when you lose a big chunk of people in any team, that business is going to be disrupted for a while. And I think that's what we're seeing in ANZ's market share figures. I mean, they've gone backwards in home loan market share in the last 12 months in a home loan market that is absolutely booming. So that's one ticking clock, Anthony. Second ticking clock is all this oil shock stuff. I mean, Nuno told us on Friday morning, none of that has appeared yet for the bank. It is all ahead of Australia. I think that's a really big message that everyone's trying to get their head around at the moment. None of the pain is here yet. It's all coming. And that's going to make it even harder to launch into this growth phase, I think. But look, he's done what he said he would do. He's been very explicit about the goals. He's come in and delivered them. What else can you want from a CEO at the end of the day? People who do what they say, the market loves them, don't they?
Yeah, I think we're agreeing, James. It's just that you want more. You just want those targets to go even higher and faster. Whereas I'm saying, you know, good work just getting this far.
Yeah, absolutely. Maybe I am a bit impatient, but the market only gets more impatient as every day goes on.
Now, James, the big economic data point this week was Australia's inflation rate for the March quarter. Headline inflation, which includes the fuel price, was 4.6% on a year-on-year basis, and the RBA's preferred measure trim mean was 3.5%, the same as it was in the December quarter. James, they're both on the way too high side. What does it tell us about two rate rises the RBA's done this year and the impact it's having on Australia's inflation problem?
Yeah, great question. I mean, the two rate rises we've had so far haven't slowed anything yet. Again, the slowdown from those rate rises is still to come. But it tells us that Australia doesn't have one inflation problem, it's got two. It already had an inflation problem before Donald Trump started throwing missiles at the Iranians and the Strait of Hormuz was closed. That inflation problem was bad enough, frankly. And now we've got another one that is all coming. It is still not here. I mean, we saw results from Woolworths this week. And again, the CEO, Amanda Bardwell there, she told us explicitly, no, haven't seen any of the inflation from the war yet. It's all coming. We had this existing inflation problem. We're going to get another one. So much of this depends. The RBA needs the economy to slow. There has to be a slowdown or inflation will not come down. The big question for me, Anthony, is how many more rate rises are required? We're going to get one next week. How many more after that will be required? And does a slowdown turn into something much nastier? I don't know, Anthony. The recession risks are rising, aren't they?
They are, James. I mean, I think these numbers show you that you can take the petrol price out of the CPI number if you want and look at that trim mean, but you can't take it out of the inflation shock. Just because you don't explicitly measure the petrol price in the inflation number doesn't mean that it's not causing inflation everywhere else in the economy.
Exactly.
The fact that people are paying more for petrol, more for diesel, more for aviation fuel, whatever, I mean, that lifts the price of everything carried around in a truck or on an aeroplane or whatever. And all that stuff, your food, your clothing, your construction materials, whatever, the price of all that stuff's going up, and that is in the trimmed mean.
Yeah.
You just can't remove higher oil prices and higher petrol prices from the inflation situation. Even if you think it's just a bit of a one-off and you blame the war in Iran and you think it's all short-term and it'll be fixed by this time next year, doesn't matter. The prices are still going up, and at the end of the day, that's the important bit.
Yeah, and you can't remove it, Anthony, from people's psyche, can you? An investor the other day made a really good point, which is sort of is logical, but you don't necessarily think about. Is there a price of anything in the economy that is so closely watched as petrol? Not everyone could think of what the price of milk or bread is, but everyone knows where petrol is basically all the time. It's ingrained in people's psyche, and that's what Michele Bullock and the RBA must be really worried about, that this idea that inflation expectations are changing in people's heads. She needs to scare that out of us some way, basically, and it's not going to be easy to do.
Well, next week's a chance.
Well, Anthony, for our first topic, toot toot, we have to jump aboard the AI train. Still have to do our own sound effects here on the Chanticleer podcast. Now, this train, which took off a couple of years ago now, is starting to look pretty unstoppable this week when we got quarterly earnings from the big US tech companies, which really confirmed that they will continue to spend up big. And frankly, investors seem pretty happy about it. Software stocks are rallying again. Chip makers or anything to do with data centers and the picks and shovels of this AI boom are soaring. And the AI bears have been sent well and truly packing by a market that just wants to go up and up and up. Now, Anthony, this is all happening while we've got a war going on and the price of oil has been up to $120 a barrel this week. It's US dollars a barrel. And we've got rates on hold or going up around the world. We've got private credit cockroaches creeping out from under the fridge. And yet this AI trade, it seems to have a new lease of life. Can anything stop this train?
It's a great test, this one. And I think it comes down to one thing. Can AI spend its way into existence?
Yeah.
And it's the thing the market's watching, and it's very much a chicken and egg situation. You know, while the market's pumped up on AI and believing in its benefits, you know, the productivity, profits more so than the social benefits I'm talking about. You know, the biggest companies in the world are free to spend pretty much whatever they want on it. Just 5 companies, Amazon, Microsoft, Alphabet, Meta, and Oracle, they're going to spend US $725 billion to build the computer capacity and data center power required to lead the AI market just this year. Now, that US $725 billion, that's a staggering number.
Yeah, it's nuts.
You know, think $1 trillion Aussie. That's 1.5 times the total tax receipts of Australia this year. That's 7 times the combined profits of all the companies on the ASX
wow.
this year. And if you take it back to the companies that are spending it, that's about 5 years worth of profits for all of them put together. And that's just what they're spending this year.
Yeah.
Like, this is wartime level expenditure by them. And it's not just spending. I mean, they're capitalizing it. They say they're spending and creating an asset that's going to produce income in the future. Now, this spending, James, it's only as good as investors' tolerance for it. And we know companies love spending money, but there always comes a point where investors go, hang on, what are you getting for it?
Yes.
Where's the return here? How many dollars of profit are you making on all that spending? How can you justify calling it an asset? Well, a couple of months ago, I reckon there was a bit of a feeling that the brakes might be applied, that thinking about this moment of need to see the profit might be coming. But I'd say that's been kicked further down the road.
Yep.
Now, James, the market just wants to believe in this AI story, perhaps because it is the only compelling good story out there, right? There's lots of things to worry about, but this is like the one that you can sort of get behind on the upside. The handbrake behind it is gone.
Yeah.
So if you step back, though, and think this is about more than share prices and where sort of society's headed and AI's headed, the more money that gets thrown at AI, even if it's wasteful spending, the more infrastructure that gets built, the more capacity there is for AI products in the future, the more these companies are going to want to sell stuff to us. So even if this spending is wasteful and the prices they're paying for data centers and chips and everything else is completely out of control and bubble prices, which maybe it will be, the fact this is getting built, it sort of wills AI into existence. The genie now is so far out of the bottle, and the money that is going to be continue to be thrown at this for at least the next 12 to 18 months is going to make the AI almost unstoppable, right?
Yeah, yeah. The genie's out of the bottle and it wants to build another 25 bottles. I mean, that's really what this is about. We still don't know if AI is going to work, but we're not going to stop spending on data centers and infrastructure to find out. So you're absolutely right. It's not necessarily about the actual AI, although that's a really interesting thing. It's about the infrastructure.
100%. So even if the people that are paying for this stuff to be built go broke, right, we're going to end up with all these data centers. What do you think they're going to be used for, right? They will be pumping out AI products. They just might be sold cheaper than what the business case thought they would. So I think we're getting it. One of the big things we saw this week, James, was some actual company results. We had 4 big tech companies on Thursday morning, Meta Platforms, Microsoft, Google, and Amazon, 4 that are at the forefront of the AI train. Can you tell us one important thing from each result?
Yeah, well, they really make it easy for us, Anthony, by putting out their results within 71 seconds of each other at 6 o'clock in the morning. Thank you, big tech giants. But yeah, it's a good idea. I mean, this was the AI boom coming to life. It's feeding through all 4 companies' profits. So at Meta, which owns Facebook and Instagram and WhatsApp, 33% top-line growth, which Mark Zuckerberg, the co-founder, he says AI is helping to drive that harder. At Amazon, they had the fastest growth in their AWS cloud business in more than 3 years.
Wow.
As everyone jumps on the AI train. Microsoft, 40% growth for the March quarter in its Azure cloud business, and business users of its Copilot AI product, the main product they sell, climbed from 15 million to 20 million in 3 months. And at Alphabet, get this, Google's cloud business was up 63% year on year.
Wow.
And its search revenue is also surging because AI is making it easier for Google to sell ads, for Google to monetize the ads that it puts around its search product. This is happening. I mean, are these proof points enough to justify that huge amount of spending? Look, maybe not, but they certainly say something is changing here, something is happening. This is real enough for the market to look at these spending plans. And look, almost all of these companies said, yeah, we'll be spending more next year, don't worry about that. The market's willing to look at that and go, yeah, okay, for now, we'll let you keep going. But the market's rally around these AI stocks has been stunning, but it's also pretty narrow, isn't it?
Yeah.
Anthony, what does that say about confidence in this AI spending?
Yeah, it's so narrow. It's being led by that AI CapEx build-out like we're talking about. The semiconductor stocks, they're at the forefront on it and they're on an absolute tear. So there's an index in the US called the Semiconductor Index, James. It's the US's 30 largest companies involved in the design, distribution, manufacture, and sale of semiconductors, right? So Nvidia, Broadcom, these big companies.
It's also got a cool name, I should say, Anthony. It's called the SOX Index.
It's up 47% in the past month. It's had only 2 down days in the past month. Went on a streak of 18 days in a row for a while there of going higher. Like, that's nuts. And it's leading the market higher. So just in April, that index, it contributed nearly half of the S&P 500's total points gained. And it was a hefty month for the S&P. I mean, it was up 10.4% in the month. So why are they rallying? It goes back to what we were saying before, right? These semiconductors, they're the AI picks and shovels. They're used inside the data centers. And how are they funded? It's those big tech companies and their AI capex, right? It's that US $725 billion that we've been talking about. And that's the sort of circularity of this thing. It all comes back to those big tech companies, the biggest companies in the world, their ability to keep spending, the investors' license that they're giving them to keep spending. But it's making a very, very concentrated rally, which is funny, James, because I reckon going into this year, I would have read a dozen or more previews for the US equity market from investment banks and fund managers and everything. And a common theme was the broadening out of the rally. We've got the Mag 7 stocks, everyone knows the big names. But this was the year where it was going to broaden out and the market was going to be about more than just the sort of tech sector. Well, it isn't. It's still, there's another leg to this thing. Now, James, I want to ask you a question. We're getting quite a few questions on AI.
Yeah.
This one's from Tom. He says, are we in a bubble? The bubble headlines have gone, but share markets in the US are at all-time highs in record-setting fashion, despite all the risk factors to economic growth in the world.
Tom makes a really good point. We're not talking about the bubble as much anymore, are we? You think about that Philadelphia Semiconductor Index, the SOX Index, that's a bubble.
Yeah.
I mean, 47% in a month. That's emotional, bubbly buying of one sector, and that's fragile. It will not surprise anyone if we see that, unwind a little bit or just some of the heat comes out of this. I think we are in a AI infrastructure bubble. People are spending money without knowing exactly what's going to come from it and where that's going to end up. They are betting on the promise of AI to a certain extent. Nobody knows quite how AI is going to develop in 10 years' time, let alone 10 months' time. So, yeah, that's bubbly behaviour. But, several people, including our old mate Howard Marks of Oaktree Investment Management, have made the point that bubbles serve a purpose. Bubbles tend to form around really big moments in business, technology, society. And so this bubble is not all that surprising. Two things can be true. The bubble is real and AI can be real. That's the way to think about it, Tom. But you raise a good point that the bubble talk has left the headlines.
You need the bubble to attract the funding and actually build the infrastructure.
That's right. Yeah.
And that's what's going on. Got another question here for you, James. Like I said, we're getting heaps on AI from Peter Macdonald, Uncle Pete, maybe. And it's about Australia's AI dreamboat or potential dreamboat, data centers play Firmus, which we spoke a lot about on the pod last week. Now, you've been talking to some fund managers about it this week. Peter asks, am I missing something in the discussion around Firmus, AI and data centers and the eye-watering amounts of dollars being invested? Is there any real confidence as to what the future revenue streams that will be required to finance these investments in the future? I'm not sure it's equivalent to gold rushes in the past where gold had a real dollar value and the boom was about how much might be found. This seems like markets and big players just believing you have to be in it to win it and that now is the time to take a big swing and hope for the best. Is it a field of dreams scenario?
It's a great analogy. It's totally a field of dreams scenario. If you build it, they will come. We're not quite sure what they'll do when they get here, but we'll just keep building it anyway. I think there's a lot of chatter about Firmus, and part of the problem with Firmus is fund managers get the idea. They get that it's in the exact sweet spot of the market at the moment, but they haven't seen any figures around what its revenue projections might look like, what its future cost base might look like, what the future capital requirements might look like, other than the fact that we are pretty sure they're going to be pretty big. People are waiting for more information before we figure out whether this is a dreamboat or a sort of bubble-ish play or something in between. And it could be something in between or both of those things combined. I think it's all going to be about the numbers, which, Anthony, we hopefully should get in the next, few weeks or next couple of months.
Yeah, let's talk now. They might be delaying it a bit, James, but
Right.
I think there's a few things they're trying to pull together. But Peter, like Firmus is a perfect example of what we've just been talking about. They're building 2 AI factories here at the moment, and they're building them for meta platforms, right? So essentially that's Facebook, WhatsApp, Instagram, like James said earlier. It's got heaps of sort of AI wrapped around and inside those products. They dish you up reels and content you're interested in.
Yep.
Like for me, that might be golf swing tips. But these products, they're highly tailored products and they're individual to the customer, unlike anything we've ever seen at scale before. This isn't like selling books, James, where you and I go and buy the latest John Grisham book and we get the same book.
Yeah.
Like these social media platforms, they're dishing up highly specific content to the actual user. And it's all AI that's doing that. So Meta's going to go out and spend $5 billion or so on these 2 AI factories that Firmus is building just in the next 5 years. It's a lot of money. I mean, this isn't a charity, right? Meta's going to want a return for that investment.
Totally.
The way it gets its return, 98% of its revenue comes from advertising. Once again, it's very specific advertising, targeted at you based on what you look at on your Facebook or Instagram, and me, the same thing. So, Firmus only exists because customers like Meta, one of the big US tech companies, wants to spend that money. So if Meta starts pulling back its spending, businesses like Firmus's aren't getting built.
Well, now, Anthony, I'm worried that you get the good golf swing tips on your feed and I get the crappy ones based on how I play. Well, Anthony, the idea of whether Firmus will make it to the ASX is a great segue to our second topic.
All right. Now, the US markets, they're booming on all these AI expectations, but the poor old ASX is in a rough patch. The ASX 200 closed lower for 8 sessions in a row, and it's getting a bit of a reprieve on Friday morning, but it's still going to be lower for the week. So if you look at the past month, James, the US S&P 500 is up 10.4%, and the ASX 200 is flat. Big Chook, you're the big brain here. What's the story here? Is this just about capital flows? Like, do people just not like Australia for some reason? Is it a temporary blip? Is it about company earnings or a combination of it all? How would you explain it?
I think there's a few things going on, but basically it's about the outlook for the Australian economy, which does flow through to company earnings, and yes, flows. So let's just deal with the flows first. This AI boom is going on. We're talking about Firmus coming to the ASX, but we don't have that many other AI boomish stocks to talk about. So if you want to play the hottest trend in the world right now, you're not buying, I don't know, Commonwealth Bank or, JB Hi-Fi or Myer or whatever. You're putting your money in Wall Street's S&P 500, or if you want to be really spicy, you're going to a hot AI market like Korea or Taiwan, home to some of the bigger players in the chip business. If you want to get on this AI train, it's not leaving from Station Australia. You need to be in Korea or Taiwan or the US or a combination of those. So yes, flows are coming out. For a hot minute there during the start of this war, Australia was seen as a bit of a safe haven. But now markets are risk on again. Things are moving back over to those hot AI markets. And of course, we're not giving you financial advice here, but that's the reality of the setup at the moment. But Anthony, we've got this mediocre outlook for the Australian economy. That inflation outlook, the fact that the RBA has to slow down the economy, that's going to hurt the profits of domestic cyclical companies. So all those manufacturers here, the home builders here, the retailers here, the outlook for them, it's not improving. It's certainly not booming at AI infrastructure levels. We've already had, 25 odd profit warnings or profit updates that have been pretty negative over the last few weeks. It's not a great outlook for Australia, and you're so right. It's not just that the outlook in Australia here is tepid. It's the fact that investors have so much choice. They don't have to be here anymore. Our super funds, they're increasingly investing that marginal dollar in overseas markets where the hot trades are only getting hotter. I talked, Anthony, about those profit downgrades. We're going into this period of the year, which is called confession season, and it typically peaks at the Macquarie Australia conference, which starts next Tuesday. You're going to be on the scene for us there in Sydney. What have we seen in terms of earnings downgrades so far, and what are you expecting to see next week?
Yeah, busy time of year, James. Companies, they should have a pretty good read by now on what their numbers will look like for June 30, whether they're talking about half-year numbers or full-year numbers. So it's time to fess up to any changes. There's always a fair few changes, and the way life works, companies set out trying to do one thing. They normally promise their investors growth, 10%, 15% growth, quite strong. And more often than not, something comes up that makes that growth harder than easier, so we get downgrades. And we've had a few already, like you said, James. So we're looking at, Cochlear, Qantas, Worley, A2 Milk, Aurora, Cleanaway, Cube Logistics. There's been quite a few. And I'd add Westpac and National Australia Bank, who increased provisioning, even if just slightly to reflect what's happening in the economy. I think the downgrades, we can put them into sort of three buckets, James. There's one that's the oil price. That's quite obvious. Flows straight through to diesel and fuel costs. Plenty of big consumers of it out there in Australian business. Cleanaway, the garbage collector, took $20 million off its EBIT, for example, even though it reckons it can pass most of the increases on to customers. The second bucket is a softening domestic economy. We've had interest rate rises here, which has hit consumer sentiment. You've got the petrol prices on top. In Cochlear's case, it's the US economy it's worried about. And the third one is supply chain disruptions, which we saw at A2 Milk. I mean, it said that just the shipping world has sort of slowed down because of the Strait of Hormuz, and the whole flow of goods has been disrupted. So it's made life a bit harder. So you think about those three things, James, and you think about the companies we've already had confessions from. I think the writing's on the wall. I don't see how we don't get more. And next week, being the Macquarie Conference, there's dozens and dozens of big businesses there. They tend to do their updates. They'll do lots of investor meetings. So it's when they typically come out. Just that huge crash in consumer and business confidence in April. I mean, that's what's in my mind. Is CEOs read that. If they're feeling a bit of that within their business, surely they're going to be feeling a bit worse about the outlook in particular than they did in the past. I mean, on the other side, James, the commodities miners are still doing pretty well. The commodity prices are still decent.
That's true.
Operationally, they seem to be going pretty well as well. Like Mineral Resources, it's surprised on the upside. This week, it's a big mining services contractor, so it mines other people's mines, and then it does some of its own as well. Even for the supermarkets, right, who are big and defensive players, like we had Coles quarterly sales on Friday morning. Supermarket sales there were up 3.6% on a like-for-like basis. But tobacco is a big part of the story. So if you strip out tobacco, you're looking at more like 5% or something growth. Which sounds good, but remember that headline inflation's at 4.6%, right? So it's it's barely more. You covered Woolworths this week, James. That was a downgrade on Australian grocery sales and earnings. The shares got hit 5%. Was that about slowing sales, or was it more about higher costs?
Higher costs, and is there something Woolworths specific here going on too? Because obviously they've had a really tumultuous time since early 2024. All that stuff about price gouging. They lost a lot of momentum to Coles. So they're trying to get it back. The CEO, Amanda Bardwell, she's doing exactly the right thing, leaning into this idea that, yes, it's going to get tough out there for consumers, but Woolworths is going to sort of stand with them. So, they've frozen the prices on 300 items. If any of those suppliers have to increase their prices, Woolies is going to absorb that, but that comes with a profit hit. So yes, Woolies is suffering, I guess, directly and indirectly from that higher energy price and the hit to consumer confidence. So yeah, it's a few moving pieces there, but again, the worst of this pain's still in front of it.
So this Australia versus the US thing, obviously RBA rates, inflation, the economy overhangs all of it. Our outlook here isn't as bright as the US. Is there any prospect this changes this year or in the medium term? And what do you think it says about the ASX 200 versus the Wall Street's S&P 500 for the rest of this year?
I think as long as the war rages on, it's going to be hard for the ASX 200 to match or even get close to matching what Wall Street does. In America, they've got the luxury at the moment, and I should stress that, at the moment, they've got the luxury of looking past the war. They're energy self-sufficient. The war doesn't seem to be affecting this AI spend, which is flowing throughout the country there, so they can sort of look past it. We don't have that luxury. The only caveat, though, Anthony, is if the war does end quickly and people get even more confident about chucking up more data centers and growing generally, then you could see the ASX improve a little bit, partly because global economic conditions are better, but partly because an improvement in global economic conditions should lift our commodity players. So the miners, there'll be more demand for copper and iron ore and all that sort of stuff. So that's one way the ASX 200 could catch up to Wall Street a little bit across the balance of the year. But again, do you want to make a prediction as to when the Strait of Hormuz is going to open? It's a tough one for investors. It's tough for CEOs. I mean, imagine being a CEO. This is the budgeting period of the year, not just for Jim Chalmers, for companies too. I mean, what assumptions would you be making about the price of your input costs? What price would you be plugging into your spreadsheet for petrol? It's so difficult, isn't it?
Yeah, it is. I think our wildcard, James, though, was and always will be China.
Yeah.
You know, if for some reason, you know, the market focus swings back to China, swings back to the economic growth there, which I think only happens if that US sort of exceptionalism around the AI story goes away. If market focus goes back to China, that'll bring some Australian stocks, particularly the big miners, back into play, make them more globally relevant again. But unfortunately, that story seems well and truly on the back burner.
Yeah, it's very true. Okay, Anthony, we'll be back after the break. It's a big week for banks and a big week for the central bank, the Reserve Bank of Australia. Back in a sec. Well, welcome back. If you want to know more about what we're talking about today and a whole lot more, AFR subscribers can sign up to the Chanticleer newsletter at join.afr.com/Chanticleer. Every Saturday morning, the newsletter pulls together the best Chanticleer columns from the week and delivers them straight to your inbox. Okay, Anthony, it's conference season. The Australian Shareholders Association has a conference in Melbourne. I've got a panel of regulators and a panel of CEOs that I'm helping them out with. That should be really interesting. Leah Weckett from Coles is on the CEO panel, so that'll be good. And as we said, you're off to the Macquarie conference to count the grey and blue suits and see what the companies have got to say.
I reckon Blues make a comeback this year, James, just for what it's worth. Yeah.
What are you going with?
Maybe I have to do one of each.
One of each?
Yeah.
Nice.
Just play it safe like everyone else in the room. Just put on the RMs and the suit.
Yeah.
Corporate attire. But yeah, no, heaps of CEOs there too. Lots of investors. Biggest gathering, I think, I'd say, of investors in Australia each year. So it'll be great.
Yeah, absolutely. As I said, we've got lots of bank results. So we had ANZ on Friday. On Monday, we've got NAB. On Tuesday, we've got Westpac. And then the week ends next Friday with Macquarie. Again, the banks are all a bit like all of us, Anthony, trying to figure out what comes next. Macquarie will be interesting, though, won't it? Because they tend to thrive in periods of energy volatility, and that's exactly what we got at the moment.
Yeah, Macquarie's a bit of a sleeper here, James. I reckon the market sort of missed the Macquarie story earlier this year in terms of just the way they do well in periods of volatility. They also snuck through some asset sales just before year end that should help their profits. But Macquarie shares have actually taken off in the past month. So I think investors are starting to price that in now, which means expectations are high, which means they're going to want something bullish from Shamara Wickramanayake. I mean, she's the queen of just taking it steady. Yep. So yeah, that should be fascinating.
Yeah, and of course, at 2:30 on Tuesday afternoon, Michele Bullock will tell us whether rates are going up or they're on hold. Anthony, what's the tip?
Feels like up, doesn't it? Maybe another split decision, but I mean, market says 69% of a hike, expects rates to be at 4.7% at the end of this year. That's 2 and a bit hikes. So I don't know. I'd say they're going up. That inflation number's just a bit too hard to ignore. I think the RBA will look past the uncertainty created by the war, just like they did in March, and increase interest rates again.
Yeah, they're going up. The rates are going up. I think the RBA is really worried about both inflation and inflation expectations, and they can't afford to sit back. But I agree with you. The vote will be interesting. You know, it was a close split decision last time. Maybe we'll get a split decision this time. So let's see. All right, Anthony, we love questions here at the Chanticleer podcast. We've already done a couple. If you have got a question you want to send in, you can email us at chanticleer@afr.com. You'll find the link in our show notes, or you can send us a question in audio form. Just record a voice memo on your phone, include your name and where you're from, and email it to us. And of course, there's also a widget on the bottom of every Chanticleer article, so you can send in questions that way. But today, Simon Hill has emailed through an audio question for us.
G'day, Chooks. Simon here from Perth. As we all know, the supply shock to oil thanks to Trump's war with Iran is driving up the price of fuel and the cost of every logistics chain in the country. This effectively acts as an unavoidable tax on most Australian households, sucking demand out of the economy at a rapid rate. So, How on earth is the RBA's solution to make us pay even more money to the banks? The Keynesian textbook says they need to take out demand to fight inflation, but the high fuel prices are already doing that job for them. Since rising interest rates won't open the Strait of Hormuz, aren't they just double taxing the consumer for a problem we didn't even create?
Oh, well done, Simon. That was delivered with some real drama too, Anthony. I like that.
It was.
I think my quibble would be, and the RBA's quibble would be, have higher oil prices really destroyed demand? And I'm not sure there's any signs of that yet, Anthony, across the economy in aggregate. So perhaps there were some earlier signs that demand was starting to be destroyed, but we've since had a cut to the fuel excise. I don't see no signs of less driving in the economy. I don't see any less signs of less demand for food or other essential services. And I think that's what the RBA is worried about here, that yes, we've had this supply shock, but we haven't really had a demand shock yet, have we?
No, we haven't, James. I agree with you that 26 cents a litre fuel excise, they got taken off. I mean, that's protecting the demand. That's the federal government here trying to look after the economy and make the RBA's job a bit harder. Surely in the longer term, if you take like a 6-month view of the world, there should be some demand destruction. Just will have to be. But like the RBA, I'm not sure it can sit around and wait for that. But also, Simon, I think we've got to be careful what we wish for here. And I'm in the same camp as Simon in a way. Like it would be great to see fiscal and monetary policy lining up and working alongside each other. And we've got a real stunning chance to see that with the budget due in less than 2 weeks. In the RBA meeting next week, it's all sort of coming together. They've sort of been on different pages in this post-pandemic era where inflation's a problem and it's partly fueled by government spending. There's a chance for the government to really rein it in and sort of be on the same side as the Reserve Bank for the first time in a while. If that happens, though, I think we need to realise that it is going to be painful and that it is going to slow the economy down quite a bit. Maybe that's what we need to stamp out inflation, but I think we at least need to be prepared for it. We've been talking about it for a while. I'm not sure if it's coming or not. There's such mixed messages coming out of the government and what they actually care about heading into this budget. But if they do really rein in the spending, if they do go hard after some of the taxes like they're talking about, we could actually get some destruction there. Yeah.
We're getting towards 5 years, Anthony, where inflation's been above target.
Yeah.
I mean, how long can we sort of accept that for? That's the question the RBA's got in their minds. And unfortunately, Simon, they've only got one tool here, and that's interest rates. It's a very, very blunt tool and, to Simon's point, pretty unfair, but I think we're going to see it wielded next week. All right, Anthony, huge week coming up. Great chance for us to see how the corporate class is doing at the Macquarie Conference as we build up to the big moment for the political class with the budget next week. So good luck down there on the floor of the Macquarie Conference.
And say hi to the Grey Army for me at the Shareholders Association, James.
Shall do. Thanks for listening. We'll see you all next week. If you like the podcast, send it to a friend as it helps others find us. And don't forget to follow wherever you get your podcasts so you'll never miss an episode. At the Financial Review, we investigate the big stories about markets, business and power. For more, go to afr.com and you can subscribe to the Financial Review, the daily habit of successful people. Chanticleer was hosted by me, James Thomson, and Anthony Macdonald. It was produced by Mandy Coulin. Head of audio is Alex Gow, who also composed our theme. And the head of premium content is Fiona Buffini. Toot toot!
The Australian Financial Review.